All right, let's jump right into this explainer. Today, we're unpacking the SASB standards for a sector that's quite literally built into the foundation of our daily lives, gas utilities and distributors, which falls under the infrastructure sector, specifically code IFGU. We're going to see exactly how investors and regulators measure the hidden risks buried beneath our streets and, tucked away inside our monthly gas bills. It's a really fascinating look at how physical infrastructure, social realities, and financial returns all crash together. Here's the roadmap for today. First, we'll define the industry itself. Then, we'll systematically zoom into three key sustainability pillars: energy affordability, end-use efficiency, and infrastructure integrity. Finally, we'll wrap up with the financial bottom line. All right, Section 1. Let's properly define the gas utilities industry under the IFGU classification code. Now, these standards, which are overseen by the ISSB, are absolutely crucial. We're not just talking about vague, feel-good guidelines here. These are rigorous metrics used by entities and investors to pinpoint sustainability risks and opportunities that you can reasonably expect to hit a company's cash flows over time. And this perfectly illustrates the two distinct business models we're evaluating under the IFGU code. On the left, we have gas distribution. These are the physical operators, the folks managing those local, low-pressure pipes that actually transfer natural gas right to end users. On the right, though, we have gas marketing. These guys act more like brokers. They aggregate and deliver gas, but they generally just use third-party lines to get it done. It's super important to keep this distinction in mind because laying physical pipe carries a totally different risk profile than just brokering supply. Moving on to Section 2, Pillar 1, Energy Affordability. Take a look at this table. It cleanly structures the three disclosure topics we're unpacking today. But starting with affordability, we have to look at the very real tension between a utility's need to make money and a customer's actual ability to pay. It's a deeply complex issue, which is why it requires both hard quantitative numbers and qualitative discussion. So, measuring this starts with the average retail rate for bundled gas. Basically, bundled gas is your all-inclusive gas bill. It's when the utility handles the whole shebang, from buying the gas on the wholesale market to transmitting, storing, and actually piping it into your home. Utilities have to disclose this average rate, broken down by residential, commercial, and industrial users. But hey, affordability isn't just about the retail rate, right? It's also measured by the absolute worst-case scenario, disconnections. Utilities must track total non-payment disconnections and, more importantly, the percentage of those folks who are successfully reconnected within 30 days. This specific metric tells you a ton about a utility's bill assistance programs and how they actually treat vulnerable communities. What's really interesting here is that the standards recognize utilities don't exist in a vacuum. They have to discuss external factors, things totally out of their control that impact a customer's wallet. We're talking local weather patterns, but also economic realities like median income or local poverty rates. Because if you operate in a high-poverty region, affordability becomes a massive regulatory and financial risk for sure. Let's move to Section 3, Pillar 2, End-Use Efficiency. Now, this might sound completely contradictory at first. Why on earth would a company selling gas want you to use less of it? Well, reducing customer usage is actually a huge regulatory and environmental win. As you can see, it's a highly effective, low-cost way to lower total greenhouse gas emissions. So regulators heavily incentivize utilities to help you use less product. To prove they're actually doing this, utilities have to report the exact amount of gas savings delivered to customers measured in million British thermal units, or MMBTU. And they have to clearly distinguish between total gross savings and net savings. Net savings are the reductions directly driven by the utility's own programs, like, say, appliance rebates or home weatherization, that just wouldn't have happened otherwise. You're probably still wondering, how does selling less gas make financial sense for them? It's all about policy mechanisms. These are the financial levers regulators pull to make efficiency profitable. Mechanisms like decoupling literally separate a utility's allowed profits from the raw volume of gas they sell. By using things like lost revenue adjustments or efficiency fee baits, regulators financially reward utilities that help weatherize your home and shrink your footprint. All right, Section 4, zooming in on our final and arguably highest stakes pillar, infrastructure integrity. This is where the physical reality of moving highly combustible gas through our neighborhoods really takes center stage. Utilities have to disclose reportable pipeline incidents, and the threshold is pretty sobering. We're talking about events causing death, hospitalization, at least $50,000 in property damage, or a massive unintentional gas loss of 3 million cubic feet. A single incident like that, it can utterly devastate a community and a company's balance sheet. Why does this matter so much to investors? Because aging infrastructure directly correlates to a much higher risk of those catastrophic leaks and explosions. Utilities must disclose the exact percentage of their pipes made of cast iron, wrought iron, and unprotected steel. These older materials are just way more susceptible to corrosion than modern pipes. And those aging pipeline leaks, they don't just pose a safety hazard, they lead to fugitive emissions. Since natural gas is mostly methane, unintended leaks are a massive environmental problem. Utilities have to detail how they manage these emissions because they bring intense regulatory scrutiny and fines. Plus, it's literally your product vanishing into thin air before you can even sell it. That's a direct financial hit. Which brings us to Section 5, the financial bottom line. So let's tie all these physical pipes, efficiency savings, and poverty rates back to valuation. How does this actually hit a gas utility's bottom line? Listen, these aren't just ESG fluff. Poor management leads directly to negligence claims, fines, and denied rate requests. On the flip side, if a utility excels at safety and affordability, regulators trust them. And in a regulated monopoly, regulators grant rate increases and profitable capital investment approvals to companies they trust. It's as simple as that. Your relationship with the regulator dictates your shareholder returns. To make sure investors are comparing apples to apples across the industry, the SASB standards use activity metrics. These quantify the sheer scale of natural gas delivered and the total kilometers of pipeline a company manages. This lets analysts normalize the data. That way you can fairly compare the safety record or efficiency savings of a massive national distributor against a small regional operator. Ultimately, as we digest all of this, we have to ask ourselves a really vital question. As the world rapidly decarbonizes and the push for electrification grows, how will these exact metrics, affordability, efficiency, and infrastructure integrity, dictate which gas utilities are able to adapt, secure regulatory favor, and survive the energy transition? It's a massive puzzle, but these SASB standards give us the exact pieces we need to start solving it.